Hey everyone, welcome back to the channel. Today we're talking about a massive shift that could quietly be setting up the next big move in crypto, token buybacks. Stocks have used buybacks for decades to push prices higher and reward shareholders. Now, more and more crypto projects are starting to use the same playbook, but with a twist that can be even more explosive for price. So in this video we're breaking down what crypto buybacks actually are, why they can send prices vertical, the hidden risks nobody talks about, and how you can position yourself before the headlines hit. Stick around to the end, because I'll give you a simple checklist you can use to judge whether a buyback is real alpha or just exit liquidity. If you're new here, my name is Your Name, and on this channel we dive deep into crypto, macro, and on-chain trends so you can navigate this market with an edge. Quick reminder, nothing in this video is financial advice. I'm not your financial advisor, I'm just sharing my research and opinions. Always do your own research and never invest money you can't afford to lose. Alright, let's talk buybacks. First, let's get crystal clear on what we mean by crypto buybacks. In traditional markets, a stock buyback is simple. The company takes cash from its balance sheet, it goes out into the open market and it buys its own shares, then usually retires them. Fewer shares plus same earnings equals higher earnings per share, which can push the price up. Crypto takes this idea and turns the dial to 11. In crypto, a buyback usually means a project uses protocol revenue or treasury funds, buys its own token on the open market, then either burns those tokens, removing them forever, or locks them up in a treasury, staking contract, or rewards pool. So instead of a vague promise like, we'll return value one day, you can literally see the buybacks happening on chain. Tokens leave the market supply in real time. This is why people get excited, because buybacks directly attack the two things that matter most for price. Supply, how many tokens are floating around; demand, how many people want those tokens. If demand stays the same but the circulating supply falls, math says price has to adjust upward over time. And if demand rises while supply is shrinking, that's where you can get those face-melting moves. So why is everyone suddenly talking about crypto buybacks? What's changing now? There are a few big forces converging. 1. Protocols are finally making real revenue. For years, a lot of projects were pure speculation, no business model, no cash flow, just vibes. But now we have DEXs and derivatives platforms pulling in millions in fees, L2s collecting sequencing and gas revenue, real-world asset protocols earning from tokenized T-bills, real estate, and more. Once a protocol has steady revenue, the question becomes, what do we do with this money? Do we hoard it in the treasury? Do we pay it out as dividends or staking yield? Or do we use it to buy back the token and burn it? Buybacks are attractive because they can quietly support price without promising fixed yields that might become unsustainable later. Tokenomics are evolving. The market is getting smarter. Retail and institutions are no longer impressed by infinite inflation plus a cool logo. They're asking, how does this token actually capture value? Is there a real sink that removes supply over time? Projects are responding by redesigning tokenomics to include revenue share right pointing arrow buyback and AMP, burn fee redirection right pointing arrow buybacks, or hybrid models where part of the revenue goes to buybacks and part to the treasury. These changes often require governance proposals and on-chain votes, and that's where the narrative starts. Proposal to implement monthly token buybacks using protocol revenue. Once that passes, every buyback becomes a mini catalyst. 3. Competition for attention is brutal. There are thousands of tokens. If you're a protocol team and you want to stand out, what's more attractive to new investors? We have a token and we hope it goes up someday. Or, we are committing a percentage of all revenue to buy back and burn our token every month. The second one is a way stronger narrative. It gives traders something concrete to model. If revenue is X and they burn Y every month, that reduces supply by Z% annually. In a bull market, that kind of math spreads fast on crypto Twitter and Telegram. So teams are gearing up to play that game. 4. Regulatory and market optics. In some jurisdictions, buybacks are actually seen as cleaner than direct yield. Paying out yield can start to look like a security. But using protocol revenue to buy and burn in the open market can sometimes be framed as simply treasury management. I'm not saying that makes it safe or legal. Regulators are still figuring this out. But from a narrative standpoint, buybacks feel like a more subtle way to return value than promising massive APYs. Now let's get to the fun part: why buybacks can make price action go crazy. There are 3 main effects you want to understand. Imagine a protocol that commits, we'll spend $2 million per month from revenue buying back our token on the open market. That's like having a giant market maker constantly buying dips. Even if traders are selling, there's always an algorithmic buyer in the background. In thinly traded markets, that alone can absorb a ton of sell pressure, reduce volatility to the downside, and create an invisible floor under price. When retail realizes, oh wow, there's a guaranteed buyer every month, they feel more confident holding, or even front-running those buys. Compounding supply shock. The real magic is what happens over time. Let's simplify with numbers. Total supply, 100 million tokens. Circulating supply, 80 million. Annual buyback and AMP, burn, 8 million tokens. That's 10% of circulating supply removed per year. If demand stays flat, but every year there are 10% fewer tokens available, the same amount of capital has to chase a smaller pool of assets. That creates a compounding supply shock. In a bull market, when new money floods in on top of that shrinking supply, you get those aggressive moves where price seems to climb a staircase and barely look back. Narrative and AMP, reflexivity. Crypto is insanely reflexive. Price influences narrative, and narrative influences price. Here's how a buyback cycle often plays out. Governance announces buyback program, right pointing arrow. Price bumps first buyback, executes right pointing arrow. People post charts of how many tokens were burned. Users say, this is deflationary. Influences tweet threads. YouTube videos pop up. Price goes higher, right pointing arrow. More people notice right pointing arrow. More volume. As volume and fees grow, buyback size increases, which supports even higher prices. It becomes a self-reinforcing loop, until it doesn't. We'll talk about that risk in a minute. Before you ape into every token that mentions buybacks, you need to know the traps. Not all buybacks are created equal. Trap number 1: buybacks funded by tokenomics, not real revenue. Some projects shout, we're burning tokens. But when you look deeper, the money isn't coming from sustainable revenue. It's coming from new token sales, unsustainable inflation, or relabeling emissions as burn events. That's like a company issuing new shares, using the proceeds to buy back old shares, and calling it shareholder value. It's just financial cosplay. How to protect yourself? Ask, where does the buyback money actually come from? Look for real fees, real revenue, real usage, not just selling more tokens. Trap number 2: tiny buybacks, giant marketing. Some teams allocate a laughably small amount to buybacks, but blast it everywhere for clout. For example, market cap, $500 million monthly buyback, $50,000. That's noise. It might look good in a tweet, but it barely moves the needle. Rule of thumb: try to estimate buyback yield. Buyback yield approximately equals annual buyback amount, market cap. If that number is tiny, like 0.5%, it's probably just marketing. But if it's 5 to 10% or more, now we're talking. Trap number 3: centralized control and rug risk. If the same multi-sig or team controls the treasury, the buyback mechanism, and the burn address, you're trusting that they won't change the rules mid-game. And in crypto, teams do change the rules mid-game. Governance can vote to reduce buybacks, redirect funds, or pause the program. In a bear market, we've seen teams say, we need to conserve runway, so we're stopping buybacks. Price usually responds instantly. Solution: prefer systems where the buyback logic is transparent, you can track it on-chain, programmatic, hard-coded percentages of revenue, and ideally, governance controlled with clear rules for changes.